Hello, everyone. Welcome to today's session. Let's get underway. Market conditions. We'll start with the long-term market timing signals. This is the big picture. We always start out with what is the market doing. That helps us drill down to the overall bias of our direction. What percentage allocation do we want to have? Are we at the top of the trend, the bottom of the trend, the middle of the trend? And that's where we start with market trend, direction alerts. And we have been talking about this. Obviously, when we talk about this part of the analysis, it's a very slow moving part of the analysis. So there's a lot of repetition because we end up talking about the same thing for months and months, which is fine because oftentimes that repetition helps recenter where we are at in terms of our risk and and our allocation and our perception and our perspective going forward in what we need to be able to do to generate profits, but more importantly, to manage the risk. Remember, that's really our core focus is on any trade, any stock trade, anything that we're focusing on. Our job is to manage risk. We can't make the stock go higher. We can't make it go lower. We can't do anything to the stock to have it go up or down. What we can do is we can decide where we buy, and we can decide how we risk, how we're managing the risk if that trade goes against us. So that's the most important part of any analysis is managing the risk, because the market's going to take care of the returns from here. And so let's talk about the long-term signal. The momentum indicator here, we're talking about this one. We're at the upper end of the range. We know that we're at the upper end of the range. This is the 20-year time frame on S&P 500, and we've had a really fantastic run. And we get these. We had a fantastic run. After COVID, we had a fantastic run, really from 2009 all the way up to COVID, 2019, and a retracement along the way. So we're due for some kind of a counter trend or correction. What that looks like is obviously yet to be determined and yet to be seen. And what we don't want to do is we don't want to necessarily try and put our conjecture on what we think is going to happen, because that's kind of futile. It really is pointless because nobody knows what the future is going to do, particularly in the stock market. Nobody knows. And so, but what we do know is we know what trends look like. We know when we're overextended to the upside. We know when we're overextended to the downside. And those are some of the things that we want to be able to focus on, is where are we at currently. In the short term, we've got momentum, which is sitting nicely in this bullish trend zone. We're not extreme. Any of these pullbacks that we've been getting have actually been pretty nice, because it resets this risk, this trend risk profile. Instead of being way up here at extreme, it moves back in. It allows for a more sustainable location. This location on this trend slider bar is the highest probability location for continuation. When we get to the upside, we get extreme to that upside, then the probability is that we're going to at least retrace back into this zone where we can then move back to the upside. So this location of this trend is really, we're looking for this direction. Okay, once we slip back into this hold and then slip back into the sell, then we start to shift trend structure, and we've got to manage things slightly different. Okay, so this is a good location for a potential of more upside. We want to see a pullback, and we want to see that momentum indicator in that zone. We also want to see breadth in that zone, which it is. Sentiment, we want to see it pull back a little bit, but that doesn't happen very often. Most of the time it looks just like this. Most of the time it's up in this extreme range during the uptrends. When that starts to really correct and move to the downside, then we tend to get bigger market shifts, or it can be a little bit more of an interesting indicator to be analyzing and paying attention to. What is interesting right here and still happening, and that is that we have divergence happening. Divergence on indicators is when price is moving one direction, but the indicator is moving a different direction. In this case, as I've mentioned before, this indicator is linked to the VIX, which is linked to S&P 500 put option extrinsic value. So as you get more and more put buying, this actually will come down, okay? And that is one of the things that could potentially be happening here is larger institutions putting on more hedges and creating this sentiment to drop down just a little bit. That's again that whether that's actually happening or not, that's who knows, but that is what we start to see at these levels is larger institutions are going to start hedging in addition to selling. But primarily they're hedging positions as we're moving into strength, and that is that's warranted at these levels. These are unprecedented levels. We're at all-time highs, really across the board, and that's just not sustainable. It is sustainable for the shorter term. For the longer term, not so much. Now let's talk about some of the other indicators here. Buy-sell ratio, which is showing some strength. We're at 1.69, which is still bullish. Okay, anything above 1 means that bulls are in control, meaning the green line is above red, and essentially all that means is that we have the number of stocks here, 1,700 in buy uptrends, 1,000 in sell downtrends. This doesn't include holds, so you're going to get a chunk of stocks that are in that hold range as well. But we had been extreme, not as extreme as we can be like this, but we are at this area where we could start to see some retracement. We're starting to see that just a little bit here with breadth. And, market, the indices, when we start to talk about those can be, those are really controlled by 20 stocks now. And so you get the NVIDIAs and Googles and Metas and Microsofts and Amazons. Those are ultimately what does move the S&P 500 primarily right now as well, and the NASDAQ 100. But markets are still moving higher. There's just not as much participation happening. S&P 500, let's look at this chart here, relatively flat and relatively, there's support here at the 579 range on SPY. One of the other things as we're analyzing is I get questions on why are these the only time frame settings and why can't I look at an intraday chart? And the reason is that it's a systematic process. It's designed to use an end of day daily chart. Part of that is for you to be forced into a certain structure. Okay, if you're always looking at your intraday charts and you're looking at the 5-minute, then a lot of times that's too fast and it creates these emotional responses that force you out of trades probably too soon. So what we want to do is with the daily chart, we want to slow down some of that action, and we only want to be able to make these decisions based on daily bars. It's one thing that allows us to create more structure into this process without saying, what does the 60-minute look like? What does the 5-minute look like? What does the tick by tick look like? I think I'll buy in here on when this does this or this does that. It just creates too much strategy hopping. And in this case, we're looking for really one thing. We're looking for stocks, high quality stocks that are moving higher, and we'll trade those and we'll try and stay in those as long as we possibly can. And then we use risk mitigation for exiting as far as stop losses and selling in certain percentages into strength. And that really is the core of what we're focusing on. So the entire site is designed around that idea, and that is, what is the market doing? What direction are we headed? Are we extreme in the trend? Are we not? What is the buy-sell ratio doing? Okay, and then sentiment, we also have, this helps on those extremes. Are we at the upper end or the lower end of those extremes? With S&P, with volatility, with bonds. Bonds have had a pretty nasty sell-off, but this was a location where we saw some support, started to bounce. So this gives us a little bit more of indication of the edges. Okay, where are we at? Are we trending, or are we at one of the edges where we could get a bounce or reversal, both on the S&P 500, the NASDAQ? We're at the upper end of that range. We already know that, but it just gives us one more perspective to look at. Then from here, we can go and analyze some of the market indices. The other factor is looking at the bond yield curve. Let's jump to that. Bond yield curve, the bond market ultimately runs the world, okay? And it's in the U.S., the Federal Reserve has so much control over interest rates, but the bond market is still trading independent of what the Federal Reserve does. And the bond market historically, when we have an inverted yield curve, meaning that the short end of the yield curve, the 3-month time frame, is essentially higher than the long end of the yield curve, the 30-year, that's a broken yield curve, and that needs to correct itself. Okay, that's not sustainable. It's designed that way to slow economic growth. It's designed to make it harder to borrow money, to make the liquidity that's in the market, the amount of money that's flowing around, less and less. That's part of the adjustment to prevent inflation. When you have too few goods and too much money chasing those goods, prices go up, and we've been dealing with that, and the Fed's been trying to make those adjustments. So typically what we want to see is in a healthy bond market, we want to see the yield curve really low on this end and higher on this end. That's the way a bond yield curve should look. Okay, so we know going back, when we see these bond yield curves that are inverted, then we know that it's an unhealthy economic scenario. We know that we're dealing with inflation. We've been dealing with COVID. We still have a kind of a COVID hangover, honestly, because of all the liquidity pumped into the system, and the Fed has been working to change that, but it's not there yet. We're seeing them come down a little bit. If you can see this just the last month or two, if I move here, you can see that short end coming down. So it's starting to happen as the Fed has been adjusting interest rates. The issue is now going to be whether it has slowed the economy to the point of a recession. So you're hearing terms like soft landing. Those, as we're seeing labor numbers or anything to do with the economy, you're getting stock market movement, because that's the biggest concern. Did these high interest rates for this long slow the economy enough to do damage? And stock prices are going to, when they do start to get any whiff of that, they're going to sell off. And that's the issue. The issue is still, we just don't have a healthy bond yield curve right now. And how is that going to unfold? How is that going to correct itself? Typically, it's more rate cuts. We've got to see that the bond market now is, we look at the TLT, which is the long end of that yield curve, you're seeing it really sell off. So all of the work that the bonds had been doing, this means when bonds are going higher, interest rates are going down. That means when bonds are going down, interest rates are going higher. So we're actually seeing interest rates start to go back up again. And that could be because of some of these economic numbers that have come out. They're very good. And so the bond market is anticipating that the Fed is not going to be able to cut interest rates, because there still could be risk of inflation going higher. So we see some of that information in the bond yield data, and it's important for the stock market. The stock market does follow what bonds are doing because of the liquidity issue. Is there a large amount of liquidity which allows for growth, allows for easy money, allows for borrowing? Okay, when companies can do that and they can use that money to grow at a really low rate, which is not the case right now. We're borrowing money at really high rates relative to the last 20 years. Then that's got to hurt something and somewhere, and that's kind of going to be the next few months going forward. Is what is happening? Why is the bond market reacting the way that it's reacting? Due to some of these economic numbers, and that's kind of my 2 cents on that. That's kind of the big picture and the really generic version of what's happening, but nonetheless, it is happening that way, and we want to be aware of that. Now, factor number 2, when we're looking at indexes, S&P 500, we looked at bonds, sectors. The sectors just give us a little bit more confirmation to some of the analysis to say, do we have all sectors in the economy really clicking and doing well? Right now, we don't. We've got a few that are starting to get weak, a little bit of softness here in energy and real estate, healthcare, starting to slow down here a little bit, but we are seeing basic materials. Obviously, we've got the big run up in gold. We've got industrials, technology, utilities. Those have all been performing relatively well. And when we start to see those start to break down, in addition to some of the other indicators that we're getting, buy-sell ratio starts to weaken, direction alerts, some of the shorter-term momentum indicators start to weaken, then we know that we're in for a little bit more of a slide. Okay, now everything's at the upper end of that range, which is when this is the time to be making the adjustments that we may need to make based on our own personal risk tolerance and the amount of volatility that we're willing to accept in our stock portfolios. Let's look at commodities. Commodities continuing to do well here, where we've seen this big run up in silver, we've seen this big run up in gold, and we've seen really those are the two. Silver continuing that press, okay, 3% higher today. And let's see what gold's been doing. Gold's up another percent today. Okay, so those are continuing to work well. USO, oil, bouncing off this bottom, back up 3% here as well. That's kind of the commodity perspective. We are seeing, when we talk about gold, gold traditionally is a flight to safety. So you get, if there's fear of the U.S. economy, we've got a massive deficit. We've got a massive debt, rather. 30 plus trillion in debt. It's ridiculous. So some money going into gold in fear of potentially U.S. or dollar related issues. That's one of the reasons why we're seeing gold have a big run up here is because of the risk that the U.S. has on our debt currently. Let's jump over to let's look at a couple of stock ideas. So again, what that process does is it gives us our bias. What direction are we trading? How much risk are we willing to take? What position size are we going to take? How many shares are we going to hold? How many stocks are we going to hold in our portfolio? So right now we're sitting at about, what's that, 35, 40% allocation. And when this starts to happen, it's because we haven't been stopped out of anything, or we're not selling quite yet. So we currently have several. We had Wolf that had a real big pop. We actually sold 25% out of that today because one of the trading plan rules are that when we hit 20% gains, we will sell 25% of that position. So we still have 75% moving higher, but we want to sell something into strength as well. So when we get some strength, we don't want to sell the entire position because we're a little bit longer term traders, okay, position type traders, but we want to get the most that we possibly can out of a trade, momentum trades that continue to move, but along the way, we also want to capture and lock in some of those gains. So the trading plan currently, we're at selling 25% of the holdings at a 20% increase. And we've had that on quite a few recently. We had actually two sales out of PLTR because it's hit both 20% and 50%. And so now we're basically out of 50% of our position in PLTR and we're trailing the rest. Okay, so we got in either back here or right here. It's continued to move higher. We sold into strength along the way up. Now it's kind of house money, so to speak. These are gains that we're working with, and we're wanting those to see, how much higher can they go. We don't want to cut it off the legs and sell the entire position because these are some of the big winners that we ultimately get, and we've got to hold on to them and allow them to continue to do that. But we also want to try and get the best of both worlds where we're selling something into strength. Okay, one of the most frustrating things is when we get a trade and we sell the entire trade, and that's it, and that stock continues to go up hundreds of percent. That's ultimately what we're trying to hold on to. Is we want to catch that 2 or 3 or 4 stocks out of every 10 or 12 that do give us those big returns. But sometimes we've got to filter through and go through quite a few trades to be able to get the one that really does have the big move. So the risk management is very important. So we end up with about, our reward to risk at the end of the day in this portfolio is about 4-to-1. 40% on average winners and about 9% on losers, with about a 43% win rate. So those stats allow us to be profitable over time and make sure our risk is managed, but we never know quite which one is going to be the big winner. Okay, we're going to get, and if we go back and look historically back at, let's go to the history and see some of the variability. We're going to get, on average, most losers, you're going to see the bulk of the losers right here in this 4, 5, 6% range. And the bulk of the winners, if we were to let me just flip that and go this other direction here. We're getting, we've had some 200 percenters, several 100 percenters, lots of 40 and 50s, 20s. Okay. That is what we're expecting out of the winners. Is we're expecting quite a bit we want to hold on to some of those winners as they continue to produce, and some of the losers, we want to cut those off pretty quickly. This is abnormal. This was a gap lower on earnings. That one hurt. But the vast majority you'll see are going to be around that 10%. The average being about 9%. Okay, and that's really what this methodology is designed to do, is allow you to hold on to the winners a lot longer, selling into the strength, but then setting stop losses on trades that just don't work. Stop losses on everything, because there's no reason not to. Okay, I'm not smart enough to know which ones are going to go up or down, so I've got to always make sure that the risk is managed. Let's talk about a trade scenario. I wanted to go over TEVA Pharmaceuticals. This is a good example of a profitable company. They're making money. It's a nice trending stock. It's been going higher. Okay, if we were looking at this case to say, I like the market condition, I want to be able to buy this stock. Now let's go through that situation where if I have a 100,000 portfolio, I've got to determine my portfolio at risk, and then I want to determine my stop loss. So in this case, if we start out, we're $18. So let's go 110 shares, 120 shares. Can go one. That's too high. So 130. 130 puts us, as I'm entering in those shares, I'm looking at this number right here without a stop price yet, because I want to see what's my portfolio at risk without my stop. This is my full position size. So my full transaction size, if I were to add into a new position, is going to be right around that 2%. Up to 2.5, down to whatever you want. Okay, this number is just what are you comfortable with as far as the amount of risk per position going into a trade. And in most cases, based on the wheel method, where we're adding in quite a few trades consistently, typically one new trade every day, and then we're managing that one trade through its trend life cycle, then 2%, 2.5%, you can go higher or you can go lower. It just depends on how much variability and volatility. 2 to 2.5% is a relatively conservative, normal type number to be able to try and get market type returns with less risk or lower risk on some of these positions. So 2%. And now we also want to add a stop loss in this. Obviously, we're not going to just hold on to that. We want to have the strategy where our stop loss is going to be typically ideally below the entire counter trend move. Okay, so if we have a counter trend corrective, red or yellow, if we can get a stop loss below all of that, technically that's the best place for it, because all of this is now buying demand support. Okay, there was enough buying demand here to push the stock up through that. Okay, here you can see here's our price. And so now we can say if it can't sustain all of that and breaks through this, then we need to be out of that trade. And that would be our stop location. So let's put 17 as our stop right here and see what that looks like. So in this case, if we had a stop loss at 17 and we bought this stock right now at this price, our risk for the number of shares that we purchased, 130 shares, puts us at $161 or 0.14 of 1%. I've mentioned this before. Typically 0.2 to 0.3 is an average range to look for. This is a little bit lower, okay, but this is a pretty tight consolidative range. We can go up to 10, sometimes even up to 14, 15% on this number, but when we have to get that high, typically we have to adjust our position size, the number of shares. We can't have that many shares if we have a wider stop. So here we could actually increase the position size if we wanted to. But in this case, this is fine. This is a great trade, great example, relatively conservative process, relatively conservative stock, large volumes, trading 5 million shares a day on average, and it's in the pharmaceutical space, and it's continuing to move higher. So this would be the setup. Now, from here, if I wanted to go out to my brokerage account and make this trade, let's say 130, let's just talk about the process. Whatever brokerage account you're using, I'm using Webull. Webull is a really fantastic broker, relatively new in the last 4 or 5 years, but the functionality is just really fantastic. I like to have chart trading ability. I like to have the ability to see the chart, and the charts work a lot like trading view, where you can squeeze it, you can push it, you can pull it, you can move it, but more importantly, you can set up a trade. So in this case, if we were looking at TEVA Pharmaceuticals, what was the symbol? I already forgot it. Where am I? There we go. Okay, it's TEVA. So TEVA, we would add that in. We would set that up. We said our stop was at 17. We must have done an example on this before. Okay, so if we did 17, that puts us all the way down here. Okay, if you don't want that tight of a stop loss, that's a pretty tight, that wide of a stop loss. 17 puts us all the way back down here, which is great. That's a great setup. Now what we can do is over here on the side, we can do either our take profit or just our stop loss when we're setting up the trade. One of the things you can do here is use this chart trader, where you can do a stop. You can place your stop as well, or you can place this first trigger stop, which is kind of cool as well. Now from here, we would determine the number of shares. We said, whatever it is in our actual live brokerage account, I'd enter in that number of shares, and then I can click on buy. Now, because we set these up in the morning, we will typically do it, pre-market, and set a limit price up above where the current price is, and then set our stop loss down below it. And then now we can even set our target up to this upper range. Then now this trade is ready to go. All I would have to do is click on place my order, and it's automatically going to set up a limit order so that the limit price is telling me I don't want to pay anything more than my limit price. Okay, so if it's pre-market, usually we can look and see what's the pre-market activity. Do I have a gap? Is it moving? Do I not want to take the trade? But in most cases, we want to say we're willing to pay up to a certain price. That's this limit price. Okay. Once the market opens, if the opening price is anything lower than our limit price, we immediately get filled. It becomes a market order, and we immediately get filled on that order. And now we're in the trade. And when you set up a bracket order like this, it will automatically set up your stop loss at the same time and your target at the same time as well. Okay, most of the time, we're not setting a target, so we can just delete that. And then from here, I could say, all right, I'm good to go. Click the buy button, and you're done. Okay. As far as for that day, that's the only thing you need to do. Tomorrow, you're going to go in and look at it and say, well, what did it do? Okay. So here in this portfolio here, you can see, Wolf, if we're adjusting stop losses, we can drag that stop loss up. We can move it however we want to. So if we have it, so just very quickly, we're glancing at that price. We're looking to say, is it moving higher? Is it moving lower? Do I need to make any portfolio adjustments? Okay, you can do it very simply with just a drag and move your stop loss to wherever that needs to be. For example, we just updated the HIMS stop loss today. So now you can see, now here's our entry price here. Here's our trailing stop. We did take 20% or 25% off the table at a 20% increase, which was on this day. So now we're managing it as it's moving forward inside of this brokerage account, setting up your stop losses. And you'll notice you want to make sure you always have your stop loss in place. It's very easy to set them up, and you can just drag them to wherever the adjustment is. Now we're setting up those stop losses. Typically, we're using a 236 location. So if we were to have bought into that, well, let's just look at some of the current active ones. Okay, PLTR, our stop is down here below this 236. Okay, the 236 is the Fibonacci location that once you've connected to the swing high, swing low on your 6-month time frame, you're using, then it'll automatically draw this line. And this is typically where we will use our trailing stop. We want to allow for this amount of volatility in order to get this potential return. Okay, we don't necessarily want to say, oh, it's moving, it's trailing, it's selling off. What should I do? Should I sell it? Should I buy more? Okay, we want to have a structure so that you know what to be afraid of and what not to be afraid of, or what you're managing and what the expectation is. In order, this kind of a methodology, in order to get that return, we have to potentially give up this much return to allow for that volatility. We don't know if it's going to go here and then it's going to rocket and then it's going to do the same thing and then it's going to go higher, or if it's going to be like, and then it just tanks and then we get stopped out. It's like, well, Some do that, some don't. But we want to be able to make sure that it's a systematic process so that we're not wondering, why am I doing what I'm doing? Why am I updating my stop loss? How am I doing that? So, and as stocks continue to move higher, this moves higher with it. Okay, so this is a trailing stop. So now we just continually, as long as that stock keeps moving higher, we will continue to adjust that stop loss higher. Let me just go through a quick example of that back here with Vistra Energy. Okay, let's say that we had bought into this trade here. We're now at this location. We're connected to this high. That's our trend. Each day, okay, now it connects to this new high. Now this 103 is the 236 location. Another day, you can see now it's 107. It's connecting to this high. So as long as the stock is moving higher, at some point it's going to capture that high water mark here, and it's going to pull back. Okay, so now it's connected here, but now it's going to pull back. Now we can watch to see what is that volatility looking like the next day. The next day, here we probably would have been stopped out of that trade. Okay, it's towards the upper end of this range. It's starting to get a little bit choppy, but you capture the bulk of that uptrend and move as you're adjusting the stop loss higher. I'm going to end on that note. I appreciate everybody's time and effort, and I hope you find value in these presentations, and we'll see you next time. Have a great day today.